Good morning, ladies and gentlemen. Well, by the time you watch this, probably the First Republic situation will be solved over the weekend. Hopefully, they will find a buyer or they will take it over, and there'll be a whole load of headlines about how the banking crisis is over. Well, if the banking crisis is over, then there is absolutely no reason for the Fed to be supplying any more liquidity. If there is a buyer, he will return all the money borrowed from the Fed window, and therefore the Fed's balance sheet is going to shrink again, and all we will be left with is QT. So I really can't see how that is bullish for asset prices, but in any case, I'm sure that the market will find a suitable explanation for it, but it can't last very long. Next week, of course, we have a whole load of stuff coming out. We have the refunding announcements, how much they're going to issue. And I'm certain they're going to completely ignore the fact that they have a debt ceiling coming up, because they have to. That's not a lot they can do about it. They have to assume that it will be passed. And then, of course, we have the Fed, and people are speculating that they will signal a pause. Well, let's have a look at, first of all, how realistic that is and where the market pricing is at the moment and how it could change. The first thing I would say about last week is that this ridiculousness that we had in the 1 month T-bill is over, and the 1 month T-bill has normalized. The 3 month T-bill has gone nowhere and is basically at what Fed funds will be once the Fed has hiked. A 25 basis point hike is almost certain. The market, though, is not asking the Fed to do more. We are not in this period where the market was way ahead of the Fed and telling the Fed that they have to hike. We are in a period, basically, that we've been for weeks in, where the market is saying the Fed is going to do one more hike, two more hikes, and then pause. Now, I am sure that the Fed is going to hike, and then it's going to stress its data dependency, probably for quite some time, and also its willingness to re-accelerate hikes in case inflation does not stabilize. Have we seen any signs that inflation is stabilizing? No, not really. All the signs are that inflation is remaining sticky, certainly in the components that matter. But, we have to give the data the benefit of the doubt. So what is likely to happen here? Traditionally, during periods of the Fed not doing very much, the longer tenures in the belly of the curve, which is the 5s and the 10s, have performed better than the wings. So let's have a look at the 2-year note, one of the wings of the 2s, 5s, 10s, 30s butterfly. As you can see, what have the 10s done, basically? Sorry, the 2s. From the level they were at before the banking crisis, they have stabilized approximately 70 to 80 basis points, even 100 basis points lower than they were, signaling that at some stage the Fed is more likely to cut than not. Is that realistic? I don't see it. I don't see that as realistic. We are in this range that we've maintained between 426 and 370 since really the banking crisis. To me, it's more likely that 2s go and trade 426 and higher, simply because why are you buying 2s at 420 when Fed funds are at 5? why are you paying 75 basis points of negative carry per day to hold twos? I just can't see it. The areas that do better are the fives and the tens, and we will now look at those, and we'll look at what the yield curve needs to say for you to get bullish of bonds. Now, fives, exactly the same story as twos. They're basically in the same area. To start getting really bearish of fives, you have to see the market above 370. These are the levels that I've been trading, anywhere between 370 and 340. To me, that is the range. If we start breaking below 340 and start trading 327, that is a signal that you have to look for 307. I don't know why that would be. I am bearish of twos and I'm bearish of fives simply because of the negative carry. But I have to tell you that during periods of Fed pause, the belly has outperformed everything else. The explanation is very simple, because if the Fed is now at the end of its hiking cycle, the market tends to push and rather look forward to what the next cycle is. It tends to say, okay, we can't buy twos because it's too early, but we can buy fives and tens and normalize that part of the yield curve. Let's have a look at tens. Exactly the same picture as the fives. 362 has been basically the high, and 324 has been, the low. Okay, so let's call it 326, whatever, but it's in this range. We need to start breaking this range for us to get bullish and a return to these kind of yields around 270. I just don't see that is very likely, because the negative carry at 270 is just ridiculous. Who can withstand that? But that is what the market is saying. And 30s are the ones that are the most stable. They really haven't moved very much, and I consider that is the anchor of the curve, and that will remain stable too. So let's start looking at the yield curve, because the yield curve will tell you which parts of the curve are going to trade at what levels that I've just mentioned. And here we can see how the yield curve has changed over the course of the month. The blue is the current and the orange is where it was exactly a month ago. And you can see this phenomenon. Twos actually slightly higher in yield. The negative carry is going to do its thing. Why hold twos 80 basis points below the Fed funds rate unless you think there's going to be an imminent change in policy lower? The 30s, absolutely unchanged. Between 20 and 30, completely unchanged, because the duration is just too long. When the market anticipates that the Fed at some stage is going to change its policy, it goes for the belly of the curve, threes, fives, tens. And you can see that this is the part that is slightly lower in yield. Threes are 8 basis points, fives are 11 basis points, and tens are 10 basis points. So almost the same. This is the part of the curve that they start buying. And actually Morgan Stanley, in this report here, and I've inserted the link in the summary page, argues very much the same. How stocks and bonds have responded to Fed pauses, if indeed the Fed decides to pause. I think that they are going to go for a hawkish pause, i.e. have some hawkish words in there, because they know full well that if they just say, okay, we're hiking a quarter and now we're pausing, financial conditions at the end of the day are going to be easier than at the beginning of the day. So why the hell would they have hiked? What makes the least sense is what the market or some market participants expect, which is a dovish pause. That makes no sense at all, because financial conditions a minute after they've said that are going to be significantly easier than before they hiked. So what was the point of hiking? To me, the only thing that makes sense is a hawkish pause where they warn the market not to get ahead of itself in no uncertain terms. But in any case, you can see that the best part of the curve, the one that performs the best, doesn't mean it goes very far, but where all the buying will be the belly of the curve, contrary to what I've been doing. Therefore, I will be very careful in trading 5s and 10s and probably start concentrating on 2s and 30s. That is the message, the historical message, which I don't think we should ignore, because it happens in periods of both, as you can read here, it happens in periods of both inverted and normalized yield curves. So here we have the 2s, 10s. What this would argue is that the 2s, 10s will start going back up towards 75 and probably try and fill this gap. Again, there is absolutely no reason to think that the negative carry pressure on the 2s is going to change. If we look at the 2s, 30s, that should remain very tight and probably start trading back up towards the 50 area. What could be the most interesting one is something like the 2s, 5s, which should now start breaking up and filling this gap up towards 60 and 63. The argument for the 5s, 30s would be actually the opposite, that it should remain weak and start going towards 29. To me, a break of this 29 area would be very, very significant, because what the market then will be saying is that at some period over the next 2 or 3 years, you are going to start getting a normalized yield curve, a complete disinversion, and every time we've had a disinversion of the curve, it has resulted in a recession. Now, that is just a fact. There hasn't been a single time that you've had a disinversion from a steeply inverted yield curve that we have not had a recession. How will we know now that it's no longer the 5s, 30s we have to look at, but it's something shorter? And this is very important, and you have to start understanding why it's so important. The stuff that's going to give you the exact timing is going to be something like 2s, 3s, and 2s, 5s. It's the 2s that have to start moving, because they are the ones that are going to lead Fed funds. The logic is very simple. If the belly of the curve can lead with a great big lag in front of when 2s start moving. When 2s start moving, that is when the timing is. That means the timing is no more than 1 quarter away. 5s, 30s can be 6 months, 9 months, but 2s, 5s, 2s, 3s is when that the timing becomes imminent. As you can see, 2s, 3s is a completely different picture from 5s, 30s. Look at 5s, 30s, look at 2s, 3s. To me, I've put in an alarm here. 2s, 3s needs to start coming down for us to have a recession signal, and then twos fives. I mean, look at the picture in twos fives. Twos fives are going back up towards filling this gap around the 60 area. So all these charts are giving you the same answer basically. Twos are going to do worse and go towards Fed funds. 30s are going to remain in a tight range, and anything that's going to get bought is the bellies between 5s and 10s. Those are the areas that are going to do the best. And now I'm going to shift my view to playing the 2s from the bearish side, being neutral 5s and 10s, because I just can't see them doing much better because the negative carry is so huge, and really all the data, which part of the data says that unemployment is starting to rise? None. NFP is going to be a bore on Friday simply because we haven't had a single component that has said that we are, that the unemployment is beginning to rise. I mean, not a single piece of data. And NFP is just that whole 4 weeks before aggregated and put in a different form. So I can't see how NFP can be weak, and therefore I can't see how the whole of the bond curve can shift lower. It can be just the parts, the wings that go up and the belly that stays stable to trades around. So to me, 2s, 3s and 2s, 5s is the parts of the yield curve that you trade towards the upside. 2s, 30s remain roughly stable, as you can see here. 2s, 30s are doing absolutely nothing. And 5s, 30s, they might go down a little bit, but to me, this area here is where they don't go any further than. To me, this 25 area is as far as they're going to go for the time being. And the yield curve basically is going to do more of what it has done up to now. And let me take it back to this. It's going to do more of this. Just these might go up a little bit, and this is going to remain the area of the bid, the 5s and the 10s. Let's not forget that we have ECB as well. And much the same kind of behavior that I've just described in the US yield curve is evident in the German yield curve as well. I think the ECB will follow the Fed. They are behind the curve much more than the Fed is. So the performance of the German yield curve should be slightly worse than the performance of the US yield curve. And I think the pressure is still going to be on the Germans over the US. But we will examine that. And, I'll give you signals to look at, things to look at to change my mind and your mind. So the 2s are basically doing nothing. I said a long time ago that I can't see them moving very far away from this 268 area, and this is where it keeps on coming back to. I think 2s, you really can't look to do much better simply because the pressure should continue to be on them in the US and in Germany because of the negative yield curve, and the fact that the ECB is further behind the Fed should indicate that 2s in Germany need to be avoided. The 5s, however, and the 10s are in much better shape, and I would not be surprised to see them trading down towards the 213 area, or the 10s trading down to around the 221, possibly even lower to the 215 area. And if you look at the 2s, 5s, the pressure is on the 2s. If you look at the 2s, 10s, the pressure is on the 2s. So I would expect exactly the same behavior. The twos 30s to remain stable, right? So the pressure is on the twos and the 30s, if the pressure is on the wings, and the bid is on the belly. Exactly the same kind of behavior as in the US. And if we have a look at the cross US Germany, I would sell Germany on any spike. Any spike. There is absolutely no way it trades higher than these highs here around what, 144. It will trade down towards 96. Fives. Again, any kind of spike, 128, 130, you're looking back towards 90. And the one that I would not touch now is this one, because 10s, they've reached their objective at 105. Not something that I want to get involved in, because if you have a look at the weekly, so you can see this area here tends to trade a hell of a lot, and it tends to trade between this 105 all the way up to 123. Should it get to 123, I'm a seller. Easy. That is one of the easiest trade you're going to get here. 123, shut your eyes and sell it. One final word is the move index. To me, the move index is normalizing, and it's coming back to where it was pre-banking crisis. You know, this is where we were in February before the banking crisis. This is the banking crisis. We're right back at it. Every time we go up, we come back down. That says that the market really, in the option pricing, is not worried about the banks anymore, and that we are in a period of relative stability in the bonds. And if what I've been saying is that the 2s and 30s basically do nothing, maybe they do a little bit worse, but we're talking marginal. We're talking 5 basis points, 10 basis points. We're not talking 20 basis points in a day. In that case, the move index should keep on coming down to around at least 105. So, you know, you're looking basically to sell calls. This is what it's saying. Putting it all together, if you are looking at a yield curve where the pressure is on the 2s and the 30s, and you know the bid is in the belly, the 5s and the 10s, you are basically looking to sell upside calls in 2s and 30s. That is the simplest trade. Well, the dollar. Right. Well, if we've looked at the differential of the curves and we are saying that really not much is going to change, twos could come in some, or if they spike higher, you're looking to sell them. Tens are going to remain stable in a range, and really you shouldn't press them. And you know that really says everything is marginal. Everything is small, and that is actually what you're seeing in the Dixie. You're seeing a smaller ranges. I will enlarge this so you can see it. This is the weekly chart. Of course, ignore this spike. It never happened. It never really went beyond that. And you can see that the closes and the opens are exactly the same on the week. It's not going anywhere. To me, any kind of a bounce up towards 102.82 is a sell, because the pressure will continue to be down towards this 139.99.83 area, which is a buy. So basically we are in a 2-3% range, and that is it. That is what the Dixie is saying. If we have a look at Euro FX, I sold 106.43, and you know, just for a quick 100 points, and I got them and I'm out. That's it. I still think this 110.65 is going to be very, very difficult to break. on a sustained basis and go any further. I think this is a consolidating market before it makes up its mind what to do next. And therefore, I trade it technically, purely technically, and I've got nothing intelligent to say about it. Gold as well, much like the dollar, I have nothing to say. I think the levels are still 2045 and 1959. I would love to see a spike down to 1959. I would be a buyer of call spreads there. But I think the volatility in everything is going down. Okay, so I would not get too excited about any movement up or down. I think everything is in a technical range, which makes sense because if the yield curve is going to do very little, if all you're going to see is minute movements, continuation of minute movements in the belly of the curve doing slightly better than the wings, why would that change any asset price? Where is the impulse? And again, there is none. So you're not going to get big signals from the yield curve until and unless the very short end starts moving, because that is when you get a signal that there's something wrong in the economy, and then asset prices can change pricing by a lot, 5, 10, 15, 20%. Until then, you're looking for 0.5% moves, 1% moves. That's all you're looking for. That is why MOVE is coming down, and that is why VIX is coming down. And in turn, when the MOVE and the VIX come down, you get the vol targeting funds basically having to buy more because they need a bigger position to run the same risk. And therefore, markets go into a consolidation. And that is precisely what is happening in gold, precisely what is happening in the dollar, because it's happening in the bonds. DBC, not very exciting, right? I think we have failed here at 24.39. Commodities are the worst performing asset class out there this year. I think we are likely to test these levels around the 23, just below 23. We have this 0.382 retracement of this whole move at 22.91. I think we'll give it another go at some stage, but I think it's going to hold. Okay, I don't think it's going to go anywhere, because if the commodities now start breaking down, they're going to start basically saying recession. Why else would they break down? Because the demand isn't there, right? And I don't see that that is a likely thing at the moment. I think it's many, many weeks away before we see that. And commodities will probably tell you that first. So again, same story here. I think you're looking for smaller ranges. You're looking for 0.5% here and there if you can make them, and that's about it. This gold against DBC, and we can enlarge this, the longer it stays at these levels, the more bullish it looks, right? Can we come down to this level? Sure, but that's just like an ABC correction of this move. That doesn't mean very much. What does mean something to me is that these moving averages, the longer term one and the shorter term one, and these are pretty long term averages, are beginning to say gold over commodities. And you'll remember this area when I kept on buying gold and selling commodities, and here we are, 15% higher. So to me, this does mean something. It means that at some stage, gold will outperform commodities quite a lot. Okay, and that move is going to take us somewhere around here. Yeah, so we are in a period of accumulation of gold and selling commodities, which can only mean that at some stage we get some kind of a mild recession. That's all I can think about. But even if you look at oil, I mean, this is the daily, failed exactly the 200-day moving average. It got down to the bottom of the Bollinger Bands. Now it'll do a few days of that, and then it'll come back down towards 64, 65. To me, that is the most likely, and this is the bigger daily. To me, that is the most likely. It's all trading very technically. If you see it here at 79.22, something like that, you are looking to sell it again or buy puts. It's a technical market, basically. That's what, and if you think about it, that is precisely what a yield curve, which does what it has been doing for the past month and what it should continue to do, tells you. The market is anticipating that at some stage you get a disinversion, which means a recession, but it's not now, because it's the wings that are moving, it's the twos and the 30s, and the belly is basically trading around until the twos start moving, and that's not going to happen for a long time, it seems to me. We're not going to get the recession, in which case commodities trade around with a slightly weaker bias. Gold trades around with a slightly stronger bias, and bonds just trade around and screw everybody. Are equities cheap? I wouldn't say so. But I would no longer say that they're hugely expensive if we are starting very slowly to, basically crawl around the times 18. You've seen from my view on the bonds that the multiplier really isn't going to change very much. But what is changing is the simple fact that with vol at 16, you are going to get vol targeting funds re-leveraging and buying equities, buying risk in general. And that is why the market is so contained and so compressed. At some stage, people who are short this market are going to have to cover. And therefore, I think, we'll examine that next. I think that we will spike higher than these highs just to piss people off and get to that kind of a level. But I think it all comes back and crawls around this times 18. And I think that is by far the most likely outcome over the course of the medium term, even 3-4 weeks. We've closed the month. Let's have a look at the monthly chart. To me, it's still all about this 41.81 level in SPX. I think if we start trading above it, we will go to this 43.95 area, simply again because it can. I mean, look at this spike here. It went to what? 43 something. So I think it's much more likely that we at some stage break it and go higher. This rejection that we had on last week when the market went down on the back of the fears about First Republic is pretty significant to me. I think we need to break these levels, and what is that? That is around 40.50, right? We need to be below 40.50 to really open the way to trade to the 3800s. What all these markets are saying is not yet. It just, that's what it is. They're all saying not yet. And to me, you can't force the timing. So let's have a look if there's another time frame which gives you a better timing. I mean, this weekly chart really is not bearish either, is it? how can you say that this is giving you any kind of a timing issue at all at the moment? I mean, I just can't see it. This is saying to me that it's far more likely to trade up here, 42.47. I think 42.47 is my level to think about shorts, outright shorts next week. That to me is a very good level to get short, to look for a return to this 41.64 area. But that's about it. And with volatility at 16%, what do you want? That is all I'm saying. The clean chart is saying much the same. Look at us here at 41.66. We get to 41.80, 81 that I showed you on the monthly level. Everyone starts scrambling. We fill this gap, 42.20. We trade 42.55. This gets vastly overbought. This indicator is always excellent when it gets to these levels. As you can see here, boom. That is when we can possibly start looking for a top and a trade back down towards these levels, fill this gap, go back up. That is the kind of trading pattern that we're in. Volatility, that is what volatility is saying, and it's as simple as that. Because if we look at volatility, I mean, this is not a bullish pattern, right? We keep on failing. We don't ever go above that very important 30.05 area during the crisis. To me, 30.11 is a close above 30.11 is bearish. End of story. But when all we do is we trade up to it and then back down, that to me indicates that we are more likely to trade these levels, which is around 14% vol, than we are to start spiking anything above. And with that, let's talk about the way vol should look like, or the vol curve should look like, going into the debt ceiling. Okay, so here we have the vol curve in the US and the vol curve in Europe. And this is, so first of all, when should the debt ceiling strike? Well, it should strike sometime in the latter half of July, first part of August. There are all sorts of machinations that the Treasury can come up with to extend it, but basically end of July, beginning of August is when, D-Day, and the market will anticipate it in any case if there's a problem. So really you're looking for the N's and the Q's to be the problem, and you're looking for volatility to remain low in K and M. The N and the Q's would be the problematic ones, probably even U, and then you're looking for it to tail off. So I would have thought that N and Q and possibly U will be the ones that go up, and the rest of the wings should remain stable to go down. So this is Q against X, which is November, and this is N against X, which is November as well. So you're looking at N and Q against the X. As you can see, we are, we've moved 100 basis points the other way, and that is why I think that VXQ against X and VXN against X look like being very, very cheap, because that is when the debt ceiling problem will be, and that is when equities will start feeling the pressure. It's a while yet, so I would basically keep on buying dips and averaging in. If you want a more conservative trade, really what one has to say is that equities in Europe are not going to have as much pressure on them as equities in the US. They're already 100 basis points lower, but that should go back to 300 or at very least 200 basis points. So this is QQ, NN, US against Europe. As you can see, we are at levels which are not discounting at all, okay, at all, that we are going to have a problem with a debt ceiling in N and Q periods. That to me is unrealistic. I think that that will go to the wire, possibly beyond the wire, and therefore these levels to me are just cheap. The way I would play them is I would keep on buying these spreads. So we're talking about Q against X, and we're talking about N against X. I'd keep on buying them on dips, but I would remain short overall by selling something like M or X. Oh, sorry, K. M or K. So let's say that I did 10 lots of N or Q against X. I would sell 2 lots extra of M or K, because I would want to be short overall volatility at the wings and have it at the belly. So, but I would want to be overall short, because look at where cash vol is. It's, what was it, 16? And look how far above cash these guys are. Why, this will converge very rapidly and then drag these with it. It's not that the market is not afraid of the vol at when the debt ceiling happens. It's just that this N and Q is being dragged down by M and K, and therefore you want to be short of M and K, because while M and K are going down, there is no way that these go up. Okay, and this is too long to be dragged. So you want to be short of vol overall. So you can do 10 lots of spread here and 2 lots extra short for it to go down, because vol is still going down. I won't show you my risk spreads against equities because none of them are bearish. And that is why I still can't get bearish of equities, because there isn't a single risk spread which says anything bad is imminent for equities. When that is the case and the vol targeting funds are re-upping because of the drops in vol, you basically have to look to where the upside is, and if you want to short an upside, you have to short a reasonable upside. We have Apple on the 4th. What is a reasonable target for NQ? Well, here it is, 13,717 for NDX, and so NQ will be 20-30 higher, whatever the differential is. So that is what you're looking for. You're looking for a fill of this gap. To me, that is almost bound to happen over the course of next week. You have my view. Bank of Japan did nothing. Nikkei, of course, likes it. 29,435 is your level. Don't sell it before then. Absolutely no point. I'm long from down here. I will sell it there. And that, then we are getting into a confluence of the Nikkei being at a sell level and the European markets slowly looking to, to top out, and the US having taken out, sort of very important levels and filled very important gaps and got everybody, overexcited and overbought, or at very least having taken their hedges off and vol down towards 14. And then we can look to the downside. I'm certainly not looking for the downside in anything before Nikkei's traded 29,435. And with that, it's the end. I've changed all the levels. What there is to change. I still think, as I've explained to you, that you are looking to put pressure on the 30s and the 2s rather than the 5s and the 10s. And I've included here the link to the article by Morgan Stanley, the research rather. It's factual. What tends to happen, and therefore I'm not going to fight it. To me, 41.81. As soon as SPX trades above there, it's a scramble to 42.55, and 13,717 is your level, and 29,435 in Nikkei. I think that should be touched first, and then when these are fulfilled, then possibly we can start coming down. But that's about it. I think it's going to be a low vol week in terms of vol to the downside, because whatever the Fed does, I think the vol targeting funds are going to start coming in and buying. Thank you very much indeed, and tweet to you on Monday.